IVM.
Right now we were at 6% plus levels 2 years back during COVID times and all. Now we are coming towards 5% levels, and as we come towards 4% type of levels, which is what RBI is saying next year will be at 4.5, because at that time our economy was not doing well. We were growing at 3.5 4%. At that point of time, a lot of people were issuing debt as a product. But now with all this, with tightness which has happened right now as far as regulations are concerned, I don't think we will go into that type of era, because SEBI regulations are very, very clear that they don't want you to take additional risk.
Folks, welcome to Paisa. I'm your host Anupam Gupta, B50 on Twitter, and on today's episode, I'm talking about debt funds, the business, the basics, and why you should include them in your portfolio. My guest, a veteran, Murthy Nagarajan, head fixed income Tata Asset Management. Mr. Nagarajan, sir, thank you so much for doing this for our listeners, and welcome to Paisa.
Thank you, Anupam.
You've been with Tata Mutual Fund for quite. I mean, you've been in the debt mutual fund market for quite some time.
Yeah. So almost around 30 years now.
Wow. And if I remember correctly, like you said, Tata Mutual Fund started in 1994. Amazing. So, could you, if you could just tell us a little bit more about Tata Mutual Fund, their history, the kind of products they've got, in where all are they placed? Because this is the first time I think that we've got someone from Tata Mutual Fund on our show.
Yeah. So we started with the initial corpus of 5 crores. That is what Tata Sons put there. And then afterwards, when we started, we started with equity. And we were really small. So when I joined, it was around 700 crores. Now we are around 1,53,000 crores in terms of size. So basically, we have consistently been following the value investment philosophy only. So what we have done, we say value at GARP, they say. So what on the equity side, we follow GARP, growth at reasonable price. On the debt side, we have got the SLR philosophy, safety, liquidity and return. So we always look at, for the debt, we always look at safety, then liquidity, then afterwards only we go to return. So we are saying that we are competing with banks, so we want to be as safe as banks for the investments.
You just help us, help our listeners understand how the debt mutual fund product has evolved in these 30 years. Now, equity, of course, people understand in the last 5 years, or the whole equity, say, your mutual fund, say, whatever has really picked up. What's been the retail participation, the retail attitude, the retail awareness towards debt mutual funds in these last 30 years?
Yeah, so if you go back in 94, 95 and all, actually people used to invest more in debt rather than equity. But at that time the returns were 12%, 14% and all. So people were more interested to go into these type of products because they were getting a good return, right? Now the YTMs have come down, the returns are at 7, the 10-year yields were just at 12%, now it has come down to around 7 quarter. So that is the band where the rates have come. But on relative basis, for the retail guys, what they also understand is that we have to also look at some amount of money to which has to be safe. So if you look at equity markets and all, you will have a 10-year cycle, you will have 5 years which are good, 2-3 years which are bad, 2-3 years which are okay. But that is where you will get some decent returns in your portfolio and you can switch into equity whenever you require. So that is what I think. Basically, people have to graduate and not look at 20%, 25% return in debt. They have to understand that this is a thing which gives you normal return like what an FD will give you.
Yeah, and that's what they compared with quite often too. So, if I were to pick up from that point, why are debt mutual funds important in a retail investor's portfolio?
So, one, you require to have a diversification in a portfolio. Then other point which I would like to tell guys is that let's say that you are a guy who's investing in savings account. You are getting 3.5%. A liquid fund is giving you around 7% return because the repo rate is at 6.5 levels. So the investments that they are doing is only in 3 months paper, in T-bills or in CDs, which are very safe. There you are able to get a 7%, almost double than what you are getting in an FD. So I think for that reason itself, you are getting almost double the return. You should, and the way in which that happens is that today you want put a redemption, tomorrow you get back the money. So this is one thing which I think people should look into this very importantly, because now people have always looked at returns as one function, but convenience, ease and getting a slightly better return than what a bank savings account gives you, that is what people should look into.
Yeah, convenience, ease, and the potential for making a slightly higher return. And the one product that debt mutual funds are usually compared with are fixed deposits. So, you have any point of view here about FDs versus debt mutual
So
funds?
FDs, if you see, you keep money for 1 year, 1.5 years. So what I have seen is that at least the bigger banks, I'm seeing around 7, 10 type of returns. So I think debt mutual funds will give you better returns than this. Plus there is ease of convenience also. You can withdraw money any point of time, and you can also time your redemptions in such a way that it's tax beneficial for you.
Yeah. When you speak to people about the debt mutual fund product, retail investors again, that's what I'm specifically talking about. Do you see any myths or any misunderstandings or any misgivings that some retail investors might have about debt mutual funds that keeps them away? I mean, for example, is it ingrained in their head that debt mutual funds are low return products, less safe products, and maybe that's what keeps them away? Anything else?
So what I think is that basically the way in which we have to look at it is that this industry has become 50 lakh industry. Banks are 200 lakh crores. So if we are 1/4 of what they are right now, and if you go back 10 years, we are 1/10 of what they were. So next I think over the next 10-15 years, we will come back to that what the bank has got to deposit. So definitely their interest will start. Basically, it is more, I think, people not knowing on debt products rather than these people. And right now, the point is that what is happening is that people are selling returns based on the past performance. So if you look at equity past performance, anybody could have given you 15 to 20% return, right?
Yeah.
Where debt will give you 7%, 8%. So that is something which is not so appealing for the investors right now. But they have to also understand that, okay, instead of keeping money in FDs or in banks, that is where you're competing. Debt is not competing with equity. Debt is competing with banks for money. So I think once people have got that idea and understanding, more and more they will start coming into those products.
Yeah, so let's talk about that event last year, because of which a lot of turmoil happened within the debt mutual fund industry, which was the removal of indexation benefits for capital gains purposes for retail investors. How have things changed for the industry since then?
So that is one basic point which was there, where investors used to come for 3 years and get the capital indexation benefit. So you could make around 7 to 8% as tax-free returns. Right now, that is not something which is possible right now. I think they should have stuck with this, and we are also representing, or at least they should bring it on par with how others like equities are being taxed 10% flat. If we come to that level also, I think more and more money will start coming. Right now, what you have to understand is that a company, once they start a company, you require equity and debt also. It is not that you require only equity. So you require, so the point is that for growth purpose and all, people will look at debt. And these are the channels through which you can go through a mutual fund or an insurance company. I think our view is that what we have been representing is that at least have taxation at the same level like what you're doing for others, rather than keeping tax at the marginal tax rate.
That comes, I think things might change.
Yeah.
Talking of things changing, what's your view of the debt mutual fund industry as such going forward from here?
So what we have to also look at we have to look at how the global markets have been. Global markets, if you see, debt has always been higher than equity in US and all. Actually, mutual fund industry is bigger than banking sector in the US. So I think they have got check rating facility and all, but I think these are all small things which are there. Over a period of time, once people get more and more convinced about mutual funds and all, they will start coming into these products.
What's the breakup of institutional versus retail today in the debt mutual fund?
Debt mutual funds, around 75% is institutional and 25% is retail.
And of the retail industry, roughly, where are the products? I mean, where are the investments placed?
The investments are more in fixed maturity plans.
Okay.
Most of the retail guys are coming there. There are some money which is flowing into this low duration products and short term and corporate bond funds. So there we are getting some amount of retail money. But most of the money seems to be predominantly institutional right now.
Yeah.
I think over a period of time, it should grow.
So if I've understood it correctly, the retail money that's there usually in FMPs or in the lower end of the site, people are just playing it safe. They just want to park it there for liquidity. So would it be right to assume that retail investors have really still not really aware of concepts like duration, like capital appreciation because of that interest rate risk and the play that's there? Do you think that might be, maybe some education is required out there?
Yeah. So right now people are not very much very much actually. I would say that on the duration side, people are not taking that type of calls right now. What they used to, even the distributor channels and all are not taking that type of call. Basically, this product has always been sold as a product for 3 years. Actually, what has happened in the Indian context is that for equity, people say 1 year, and for debt, they used to say 3 years because of the indexation thing. That's how it has been sold.
Yeah.
But now there is a decent amount of money that you can make in duration products, because right now the feeling is that you will definitely get a return better than an FD.
Yeah.
The expectation is that now going forward rates will remain like this or it will come down. So because the CPI inflation is expected to be around 4.5.
We'll come to that.
Yeah. So that actually should see to that investors, at least if they are there in those products, they will make something better than what you're making in FDs.
Yeah, and I mean, I've always thought that the debt mutual fund industry actually has more retail-oriented products than the equity mutual fund industry has, right? You've got tenure, which is that you can put it for something as short-term and liquid from overnights to 1 month to 3 months, and you've got right all the way to the long end of the curve. And I don't know, yet people seem to be a little bit, either it's ignorance, either it's a reluctance, or it's just that, like you said, if equities are offering a much better rate of return right now than the debt mutual fund industry, I hope that will change. And we are actually going to be talking about that on the other side of this break. Folks, we're going to talk about the interest rate cycle, what Mr. Murthy just said about how going forward, where interest rates are right now and the possibility of them going down and how that affects debt mutual funds. All of that after this short break. Coming back in 3, 2, 1. And welcome back. Okay, so now let's talk about the your outlook and your view. Let's start with the interest rate cycle per se. Yeah, where do you think we are? Because I think there's been a lot of activity, the way the market perceives the US Fed or the RBI out here in terms of rate cuts. So I think let's start with where do you think we are and therefore where we are going.
So what we are told to understand is that we have got an inflation target regime from RBI. So they say that our inflation should come towards 4% levels. So right now we were at 6% plus levels 2 years back during COVID times and all. Now we are coming towards 5% levels. And as we come towards 4% type of levels, which is what RBI is saying next year will be at 4.5%, then there is a scope for 50 basis point of rate cut starting. My view is that it will be much higher. Than 50 basis points. And we also have to look at what is happening in US market. The US economy is growing at 2%, they are at 5.5% in overnight rates. So there will be further rate cuts which will happen. So there are a lot of money which will flow into the emerging markets. India will be significant beneficiary of that because we already are coming into the emerging market bond index. So JP Morgan, that's around 30 billion will come there itself. And people will start looking at better alternatives which are available in the Indian markets compared with global markets. So what you have to understand is that we have got an economy which is doing well. It is expected to grow. Our debt ratios will start coming down over a period. So incrementally will be much beneficial compared with developed markets where the debt to equity ratios are actually going above 100. Our ratios will come closer towards 70-75 levels. So we are much better off them, and there is decent amount of money which will flow into the Indian market. So you will have a good amount of flow of money coming into Indian markets. My view is that this year you will have more debt money flowing into India compared with equity money which is flowing into India.
Wow.
So that actually will see to it that what we have seen in the equity market in the last 2-3 years because of money flow coming in where the markets are always buoyant. The same type of thing we will see in the equity markets, debt markets. You will not get that type of returns what an equity gives you, but you will definitely be able to get a returns better than what an FD gives you.
Yeah. So I want to talk about that. Money flowing into the debt market. Now we've obviously made the case about money flowing in. Where's the supply? Do you think because the government themselves have said that this year I think the estimate surprised a lot of people being on the lower side than expected, and in the next couple of years the fiscal consolidation will continue.
Yeah.
Do you think that that private Indian corporates will actually raise money? What do you think about that?
Yeah. So right now the biggest guys who are raising money is the government right now, and then you are looking at the PSUs who are raising money. Private has not raised money, one because they have already got some amount of excess capacity, and plus they have got cash, which again is sitting in the mutual funds, debt mutual funds. So that actually will have to come down to some level, and then afterwards they will shoot this capex. So my feeling is that good amount of equity money, good amount of debt money and equity money is coming into a market. So you will see that both these markets will do well going forward. So this is my take.
Okay.
Yeah.
The inclusion of India in the bond indices globally, in which instruments will that money come in? I mean, just like equities go into index funds or the index broadly and not lower down, how will that play out for the debt market?
So it will play out in the 3.5 to 10 year type of buckets where the money will flow. That is what they're saying. That is where the index will be, and some money will flow in 14 year also. But regardless of that, what is happening is that the supply on the fiscal side is on the lower side next year. It is 14.13 lakh crores. This year we are ending at 15.34. So next year we are actually, in absolute number, we are lower.
Yeah.
And the demand is higher. So around 3 lakh crores will come from the FIs only.
Yeah.
So with this type, and then we have got this NPS, we have got the EPFO, all these guys, a lot of demand is there for debt side. So the point is that we feel that the 10-year yields may not go below 7.10 on the upper side. Yields, we are at 7.07, so 3-4 basis points here and there. And downside we will have to see, depending on how the flows, whether we go below 6.75 or we'll have to see.
I mean, where's this same question again? I'm just trying to understand where can the supply come from, because if so much money is coming in from everywhere, foreign, domestic, government, sorry, not government, but if that's where the supply is coming from, who's going to issue that much to absorb that comes in? I mean, in the previous years, I could understand it's local. But now I don't know what the numbers are if India gets included in the bond indices, the quantum of that.
So around 25 to 30 billion is what they're
USD?
Yes.
Okay.
So that converts into around 3 lakh crores of money which will come.
Okay.
So the feeling is that RBI will come. RBI has been buying bonds during COVID times. So RBI will come and issue some amount of bonds.
Right.
Or they will do switches. But they will also do it in a non-disruptive way. So because they also want the government borrowing program to go through.
Yeah.
And they also want that the PSUs which are there, they should also be able to borrow. Yeah. So to understand this, next year our capex will is around 11.11 lakh crores. So if that type of capex come, definitely your supply thing, the logistic cost will definitely come down. So if your logistic cost comes down, your manufacturing and your CPI core inflation will come down. And if the monsoons are good, then your CPI inflation will be closer towards 4 or below also.
Yeah.
So what has happened? What we have seen is that in China and all, when this thing happened, interest rates came down drastically when the FI money starts coming in. So actually, in fact, the Chinese interest rates are lower than US interest rates.
I didn't know that. Yeah.
So China, and we have got one of the highest interest rates. We say that 7.10 people may not find attractive, but globally, looking at how the global markets are, where yields are at 2%, 3%, 4% in Europe and all. So to give you a context, the countries which are having higher interest rates compared with India are names like Pakistan, Sri Lanka and all. Here, people will not invest because of the currency issues which are there. Yeah. But here you got a stable currency, you have got very high, we have got decent amount of returns for the foreigners who they're looking at to invest in. So you will see good amount of flow of money coming in.
Okay, now given whatever you said so far in our discussion on the money coming in and the supply of bonds by the government, on inflation, on interest rate cycle, you expect 50 basis points in the next 1 year maybe?
Yeah.
Okay. Then what is your strategy for our listeners? That if they have a debt mutual fund portfolio, if they want to start a debt mutual fund portfolio, and if you can just help us on the spectrum of conservative all the way to aggressive.
Yeah. So, good. So, what I would say is that if you, right now, what they should do is that if you've got 100 rupees which you're going to put in debt, 40 rupees you can put in gilt funds or low duration, high duration products.
And when you say that, you mean 10 years plus?
10
7
years
plus?
So 7 to 10 year, 7 to 10 year GSEC, dynamic bond fund. So these are all products which are there where 40% allocation can happen. Another 40% allocation can happen to your low duration products, short term bond funds and all. Another 15-20% you can put in ultra short term bond fund, liquid fund and all.
Wow.
So that's how less than 1 year should be 20, 1 to 3 year, 5 year type should be around 40% of the portfolio. Another 40% should be in your GSEC, dynamic bond fund and long duration products.
This is for the conservative investor?
So that is for the conservative investor. If you are an aggressive guy, then you can go up to 60% in gilt fund and all.
Yeah.
Another 30% and keep only 10% in cash.
Why am I not hearing credit risk here?
Credit risk right now, the spreads which are there are not so great right now. The point is that you are getting such a good rate in government securities and in AAA PSU bonds. So there is no need for you to take additional credit risk. What is happening now is the spreads which are available between your AAA PSUs and the credit funds will be around 70, 100 basis points. So it's not a great, for the taking the 100 basis point risk, you can make that type of money by price appreciation only.
Do you think that will change? There used to be a time, I remember, I don't know, 17, 18 or maybe 16, 17, 18 where credit risk was actually a big thing.
Yeah. So at that point of time, people were interested because they were getting around 10% plus type of the thing.
Okay.
Because at that time, our economy was not doing well. We were growing at 3.5%, 4%. At that point of time, a lot of people were issuing debt as a product. But now with all this, with tightness which has happened right now as far as regulations are concerned, I don't think we will go into that type of era because SEBI regulations are very, very clear that they don't want you to take additional risk, particularly, so they don't want you to take. So people will be more focused with AA minus type of names. I don't think people will go towards credit risk in a big way.
Yeah, I mean, we've already seen one fairly high profile event happening during the lockdown. So where is the debt mutual fund industry on that matter? Do you think it's stronger now going forward?
With what happens with regulations? So with regulations, what is happening is that we sitting on the other side, we can complain, but the point is that over a period of time, the fund has actually, the corpus of this mutual funds have actually grown. So I think it is a thing in the right direction only.
I mean, at that point of time, a lot of distributors are also aggressively marketing debt mutual fund products to retail investors, given the kind of returns that some schemes were offering at that point of time, and more importantly, because equity markets were not giving similar returns. I'm just trying to, extrapolate going forward. Now, retail interest towards debt is probably at a recent low. I haven't seen so much of disinterest out there, given that equities is kind of giving pretty good returns. I'm just saying that what can change going forward, and how strong is the debt mutual fund industry today, given the lessons it's learned? I don't know, tomorrow if any panic happens, do you think that we could have a repeat, or do you think that we're better off now?
So what has happened as far as debt is concerned, there has been significant amount of portfolio oversight from SEBI. So what we have got, and from the industry itself. So for any fund which you have got, let's say you got 100 rupees, you have to keep 10 rupees into cash or in government securities. Another 30-40% you are going to keep in AAA assets only. So the balance only is 50%, 60% there. And there also, point is that if there is any downgrades, there is a oversight from the trustees and all. So right now the industry said that we are worried about downgrades. So there is forget about defaults. So now we have come to a situation where the industry is worried about downgrades. So point is that, to that extent, this has become very safe. Over a period of time, you will get money. Obviously, you are not going to get your 10% return over a prolonged period of time, which was there in credit funds and all. But over a period of time, people will see that, okay, you are getting 7%, 8%. People will be happy with that. That's what I think so.
Okay. Yeah. So I want to understand, you mentioned about how you would allocate between 40 to 60% in a longer term GSEC, gilt fund, or even a dynamic fund. Help our listeners choose something good out here. What should be their general criteria? What separates one from the other?
So gilt. So as far as duration products are concerned, you have to look at the what is the duration of the particular product. Somebody is earning 7-8 years. If your view is that interest rates are expected to come down, definitely you should go into those products. Then you have to see to it that they should be in GSECs or in AAA papers only, so that they will get the benefit of the fall in rates. If you are going to be in lower rated papers, so what happens is that you will not get the benefit of fall in interest rates. So that is what you should see. So all the things, what you have to also see is that if people are saying that, okay, they are buying short-term papers, you have to see the long-term rating of that also. There is a riskometer also which has been given by SEBI. So that also tells you where the fund stands as far as the risk of the particular scheme is concerned. So based on that, they can take a call. Most probably, I think the focus should be more on credit, what type of credits they are taking, but returns will be, for debt products, you will have returns which are 10-15 basis points here and there. You will not have too much of difference, but you have to look at the credit aspect of it actually.
You're better off looking at the credit risk, the credit rating and the paper rather than going after the returns.
Returns, and you have to look at duration. Like since you're going for long duration funds, then the fund should have a higher duration, more than 5 years, 6 years.
Okay, my last question, sir. Passive, whatever happened to them?
Passive, there's loosened amount. There is some amount of money which is coming now also in this. The indexation benefit was there. But people, if you want to have only G-Secs or only AAA, so those guys, it is like an FMP for you. 3 years, 4 years, you go into those particular funds, and you feel that after 1 year you have made your returns, you can exit at any point of time. You can enter and exit at any point of time. So definitely there is a space for that also. So it's like an FMP, passive FMP for you. You can enter and exit at any point of time.
Yeah, but I mean, come on. I mean, given where interest rates are, where they're going, active would make better sense for, if someone who wants to take that kind of risk. What do you think?
Yeah. So right now, yes. But over a period of time, if people are, depending upon the risk appetite, like you said, there's a conservative guy.
Yeah.
So, he said, I don't want to have too much of risk. So, I'll be in the 3 year, 4 year, and I know what are the papers which are there. So, I'll go for that. So, those guys can come for that.
Lovely. So, folks, there you go. That is your strategy for debt mutual funds, how to allocate money for the conservative guy, for the aggressive guy. When you're looking at 50 pips cut in the next 1 year plus?
Yeah, within 1 year.
Within 1 year. 50 pips, which honestly can, change debt mutual fund anyways meaningfully. So what is the rough calculation here of NAV appreciation versus interest rate fall? I mean, there's some...
Yeah, so if you're running a 6 year duration, let's say, and 50 basis point fall happens, so $3 should come by price appreciation. And you're 7.5. So closer towards double-digit returns.
Not bad.
You should be able to get.
In a more stable way.
Yeah.
As compared to equity, and you can sleep at night, hopefully.
Yeah.
Okay. So last question, that is for our listeners. Standard question that we have is, what book are you reading? Any content recommendations you have for our listeners? Yeah.
So I think people should, what I feel is that maybe I'm a dead guy. I'm saying this, The Psychology of Money.
Oh,
so I think
classic.
Yeah. So I think most people should actually look at what can happen wrong, because I think that is one thing which we look into and accordingly plan, because good times don't last, bad times don't last. So now we are in good times. So we should also plan for our bad times. So that's why I think that people should look at Psychology of Money, how people actually react once you get money. Once it's always like that, when you make money, you put more and more, right? And then afterwards at the top, you lose money.
What do you think can go wrong for debt mutual funds? Industry as such,
we are pretty well regulated right now. So
maybe at the macro front probably.
Macro front, if oil goes to 100.
Okay.
If oil goes to 100, then afterwards we have got some other events globally. Geopolitics, which again will be temporary, I think so. But things, because we have seen this Ukraine war, and afterwards we have seen where oil is, right? And where all commodity prices are. All the commodity prices are lower from what was during Ukraine war.
I mean, I haven't seen this kind of Goldilocks situation for quite some time. So let's hope that it stays that way, or at least good conditions remain for the market, folks. But that is it. That is a wrap on this episode. This episode of Paisa Vaisa. My guest, Murthy Nagarajan, Head Fixed Income Tata Asset Management. Sir, thank you so much for doing this for our listeners.
Thanks, Anupam.
Thanks.
Yeah.
IVM